Let's begin with a big global piece, which is this corporate minimum tax worldwide. First question I have for you is, and just to recap for everybody, the idea is that there are some countries that charge a much lower tax, some zero, some like Ireland in the 12% range. The idea is, well, we don't want, if we're going to increase the taxes on corporations in the US, we don't want the corporations just moving overseas, which is, by the way, what they did prior to 2017 Act, which was the intent to bring them back. So rather than we may be pushing them overseas, but if they can't go overseas and get a lower tax, then presumably they're going to stay here. Have I got that right, Kyle? Is that kind of the idea behind this?
Yeah, a big part of Biden's tax proposal is a large tax increase on U.S. multinational corporations. So he's proposed raising the statutory tax rate from 21% to 28%, and then raising the tax burden on the foreign profits of U.S. multinational corporations. So what he wants to do, just very generally, is when a U.S. multinational corporation earns income overseas, he wants to bump up the minimum tax that the U.S. would place on that income to 21%. Now, you're right, there's a big trade-off here. Now, what they want to do is reduce the incentive companies have to shift profits into low-tax jurisdictions. But the trade-off is you'd also encourage companies to shift to their headquarters out of the United States, because this minimum tax would only apply to companies if they're located in the United States.
Right. So there's this constant push. There's this fight between the countries that say, well, we're willing to do a lower tax to encourage the economic development versus we've got economic development already, so we want more taxes out of the companies that are already there. Yeah. All right. It's, some of it's kind of mystifying to me, that realizing that, boy, companies can move. And at least what the government's saying is we do realize that tax incentives do have an impact on corporate behavior. So here's my only question on this one. Who pays this tax? Is this, do corporations and their executives pay this tax, or will this funnel down to the average person in America?
You see in the media all the time, the shorthand here is that corporations are going to face the tax increase, or multinationals are going to face the tax increase. But economists always like to try to track it down to who is actually bearing the burden of the tax. And in the case, it's always people, whether it's shareholders of those corporations, the workers of those corporations, sometimes the consumers that buy products from those corporations. So that's who's ultimately going to bear the burden.
But let's talk about, there's really a couple of proposals that I think are so important to the average investor, business owner. And let's start with the little one, which is the Social Security tax on pass-through entities. So can you just kind of walk us through what that proposal says and what's the consequence going to be to the average, the average small business?
What this proposal is seeking to do very generally is subject more business income to either the Medicare payroll tax, Social Security payroll tax, or the net investment income tax. If you're not familiar, the net investment income tax was passed as part of the Affordable Care Act. It's a 3.8% tax on certain investment income and business income of passive business owners of 3.8%. And it's supposed to match up, roughly speaking, with the Medicare payroll tax plus the additional Medicare tax.
And if I understand, Kyle, this money's all supposed to go to Medicare, right?
This is all supposed to go and fund Medicare.
Let's take the S corporation, which is kind of the heart of the American small business. Okay, so right now, if you earn income, that income is subject to income tax, but it's not subject to Social Security tax unless you pay it out as a salary. Right. So this would subject that to this Medicare tax. Okay. Which then opens the door, of course, to down the road, subjecting it to whatever the limits are on Social Security tax, which is probably, to me, a lot bigger deal. And I think that's maybe the next ball to drop. But let's say it's just a 3.8%. Okay. So Kyle, would this apply whether or not I distribute the income? Because of course that income is taxed to me income tax wise, even if I leave it in the company because I need it, let's say, to grow the business next year. But unlike a corporation, now a big corporation, a C corporation, that is not subject to that net investment income tax unless it's distributed.
Yep.
Right.
Yeah, that's right.
But
yeah,
in this case, as I read this law, the income would be subject to the net investment income tax, effectively the Medicare tax, whether or not it's distributive. Am I reading it the right way there, Kyle?
That's right. I'm reading that proposal that way as well. A big distinction between traditional C corporations and S corporations partnerships is the ability to defer that second layer of tax and defer the net investment income tax when until profits are distributed. S corporations partnerships don't get the benefit of deferral, and that's not going to change here. So when the income is earned, it's also taxed in that year, and it will be subject to tax under the net investment income tax and the Medicare tax.
Now let's go to the big one, which is the capital gains. I think this is the biggest proposal in here. I think it's the most egregious, and it covers all the way from estate tax to gift tax to basically unrealized capital gains. I'm not talking about the carried interest. I actually do have, let me make sure I come back to that because I have one technical question for you on that. But on this capital gains tax, so as I understand this, the way it's written, if I took my business and I put it into an S corporation, it's not subject to tax. That 351, that regular transaction, non-taxable transaction, I put into a corporation, not subject to tax. On the other hand, if I took the same business and I just put it into a partnership, I'd be subject to tax as if I sold the business. Am I reading that the way you're reading it?
Yeah, so this was a question that I got from someone else as well, and I believe that's how another tax lawyer interpreted this, and that would be a major change. I haven't thought this issue through too much, but you are not the first one to interpret and read it that way.
So why would they do that? I mean, the reality is, this is, for those of you who don't know, this is section 721 of the code, which is my specialty area, technically, is partnerships. It's been around as long as the corporate, you put something into a partnership, that's a non-taxable transaction. Why would they do that? What's behind this? Because it seems so anti-small business. What are they trying to get at here?
Potentially an anti-tax avoidance measure, but I'm not sure. I haven't. They did not have, and your question implies this, they did not have a robust discussion of the purpose of this change. So
part of this is the gifting provision, right? So the idea is that if you gift, so that you can't get away from the capital gains on death by gifting, that if you make this gift, then that gift is subject to not gift tax, but income tax. Yep. On capital gains, right? So as you read the Green Book, how would this apply? So we've got this $1 million limit. Is this a $1 million lifetime? Because I couldn't follow that in the Green Book, frankly, Kyle. It would seem to me it would have to be a lifetime limit that once you got over that $1 million, everything over that would be taxable. Is that the way you read that? It has nothing to do with the level of your income. It's not like the capital gains tax over $1 million of income. This is rather a capital gains tax based on, I think, a lifetime giving over $1 million. Yeah. So this provision is somewhat confusing, frankly, a lot of the Biden proposal is confusing because they use many different thresholds that use many different definitions of income. So just for maybe some context here, and their capital gains proposal has two general changes. The first change is that capital gains realized the treatment of long-term capital gains will change for any
for anyone with taxable income over $1 million. So that income would be taxed at the top ordinary tax rate, whatever that ends up being under Biden's proposal. He's proposing 39.6 plus the net investment income tax, but we don't know what Congress is going to do. And that's taxable income $1 million plus. Then there's this second provision, which is the taxation at death of unrealized gains. And that is a different threshold. And I think you're right that that's more based on the lifetime limit rather than any threshold of taxable income or adjusted gross income. And I think it has to be that way. Some other details here too is that the taxation of death will also have exemptions, not well specified yet, but exemptions for primary residences that will remain in there, and they also will have an exemption for certain businesses. So if I think their intention, and I don't know, they'd have to work out the details, is that if the stock is passed to say a family member, and that family member continues to actively run the business, there would be an exemption there too. But we'll wait and see. This is, like you said, as Congress is discussing this more, some members are becoming uncomfortable with it. And I mean, it's too bad for Biden because this is where he gets a lot of his revenue. And we don't know if this is actually going to happen at all. There are some Democratic lawmakers that state that this may be too much of a tax increase for them.
Okay, so carried interest right now, we have this 3-year rule. And there basically says that if you have certain carried interest, which is basically somebody puts in services in exchange for the appreciation on the investment, and that appreciation on the investment historically has been taxed at long-term capital gains rates, but that under this new, under this 3-year rule, now you have to hold it for 3 years. One of the things that was really interesting because this came in 2017 in the Trump Tax Act. One of the things that was very interesting is that they very much specifically left out real estate investment in the 2017 law, and the IRS confirmed that in their rulings and their regulations. So my question to you is, do you think that they will maintain that exemption? A lot of our listeners are real estate investors. They're very interested in this. They're syndicators. They raise capital all the time, and most of their money is made on the carried interest. So do you think that they will continue that exemption, or you think they'll bring real estate back in?
Not sure. So if we look back to the Biden campaign proposal, they did suggest that they would go after unspecified what they would call real estate tax breaks. We didn't really know what those were, whether those were accelerated depreciation for real estate investments or carried interest. We didn't really know. Now, that at least suggests to me that that's in the back of the mind of the administration, but we haven't seen yet what Congress thinks about what they do with that provision. So right now we're kind of in a middle ground where we kind of know what they want the rates to be and some of these thresholds, but we don't really know what they want to do with the base with respect to real estate. But that is something to keep an eye out for in the next couple months.
Let me ask you one final question, Kyle. Biden has maintained from day one of his campaign that none of his proposals would have a negative impact on anybody making less than $400,000. Do you agree that that would be the consequence of these current proposals?
Yeah, so I think there are a couple problems with that threshold. So first, it leads to very complicated tax policy. We're just talking about the carried interest provision. So it's one thing to get rid of the carried interest provision altogether, but what they're doing is getting rid of it with an income threshold, which adds additional complications to a provision. So that's problem number one. Problem number two is that the Biden administration has kind of arbitrarily enforced this limitation. So clearly the $400,000 threshold that they're working with doesn't apply to the corporate tax, because
Right.
if it did apply to the corporate tax, they'd already been violating it, because the corporate tax eventually does fall on people earning less than $400,000, whether you're a retiree that owns stock and gets you live on interest and dividends and make only $40,000 a year, or the worker of that corporation. But the Biden administration has said it doesn't apply to the corporate tax. That's their way out of it there. Now, the individual provisions, there may be some small places in which people earning less than $400,000 could be impacted by the provision, by any of these provisions. We talked the capital gains provision, for example, taxation at death. Who is ultimately going to bear the burden of that tax increase? Well, the person who passed away isn't, because they're not alive, right? You can't bear the burden of a tax if you're not alive anymore. If you're passing on that asset, you could be passing it on to someone whose annual income is below the threshold. Now, so there is potential for mismatches.
On top of that, Kyle, I mean, consider that you could have a business that makes $300,000 a year, that when you sell it for more than $1 million. So, that's a tax. To me, that's a tax on somebody making $300,000 a year. And the reason it is because it's really no different for a business owner. If you have this tax, this high capital gains tax when you sell your business, it's no different than if you took your 401k and the day you retired, you were taxed as if that entire amount was distributed. It's exactly the same consequence. And yet that's never going to happen. We can't wait to plan until we know what the answer is. We have to plan based on what we think the answer might be, spend a little money for the planning, knowing that we don't have to sign that final plan until December 31st. So I think with that, I think we've got some flexibility going on here, because what happens is we do all those three things, we're going to always make way more money and pay way less tax. See you next time. Thanks.
You've been listening to the WealthAbility Show with Tom Wheelwright. Way more money, way less taxes. To learn more, go to wealthability.com.